would admit yourself the trend has been going in the right direction, which leads the Fed to, you would want to believe, think that they can be patient from here forward, don't you think?
I definitely think so. I think they've hiked too much already. They should have been using the balance sheet more. I feel like they keep hitting the same nail with the hammer over and over and over again. Like, they have monetary policy. It's not one policy, it's policies. And that includes using quantitative tightening, and they've been really pansies about it. They really haven't gotten bold with reducing the balance sheet by having these caps in place. And then Silicon Valley Bank, they just created more liquidity and increased their balance sheet again in March to save the banking system. So I think they could really ease off the rate hikes, use more quantitative tightening with their balance sheet, and stop doing the same thing over and over and over again.
So just because you believe that they've done too much doesn't necessarily mean that they won't do more. Do you think, like Jeffrey does, that they're done?
I think we'll probably get one more hike. I'll take the over on that and say through the end of the year, I think we'll probably get one more. But I do think the market, if you look at Fed Fund futures, is expecting rate cuts next year. And I think that will be the real surprise for markets, right, is if the Fed hikes and holds longer than what we're expecting, because pretty much all bond managers, whether you're a king, queen, or something else, everybody's coming out and saying, where are the cuts, right? Everybody is looking for these rate cuts. And it's kind of like deja vu a little bit, because if you think about, back in 2021, nobody was expecting the Fed to hike 5% interest rates in about a 12-month span. So I think it's very difficult. You don't want to be stuck with consensus thinking, and I think we'll have to see what the data shows, but it's also the Bureau of Labor Statistics, and revisions happen all the time.
Bond market volatility is something that you obviously follow and invest on, where you see that going. Would you be willing to say that the volatility in the bond market has been pretty modest almost throughout this whole stretch of rate hikes, except for a few periods where things got a little crazy?
Yeah. How
would you describe what you've witnessed in your expertise, in your area of the market, through a little more than a year of rate hikes?
Yeah, definitely vol is very muted. I think a lot of people focus on equity volatility, but the thing that kind of is lurking in all of your viewers, you have fixed income vol that you're short if you own things like mortgages. Any place you own a mortgage, if you think about it, a U.S. homeowner can prepay whenever they want. They own an option. If you own the mortgage, you're short options to them, and whenever you're short options, you're short vol. So the big surprise, vol has not gone higher, but if we do see an increase in fixed income volatility, that will mean price going down in mortgages. And so it's really important to understand things like the ag index. A third of the ag is mortgages. And then if you look at the Fed's balance sheet, it's still about $8 trillion. The Soma holdings have gone down about $1 trillion, but the balance sheet expanded with Silicon Valley Bank. A third of that is mortgages.
But Jeffrey likes mortgages, and he's liked...
Well, he's maybe the mortgage king. Maybe we can agree on that.
He's liked it because, and he made the point, people are sitting in 3% fixed mortgages, or perhaps, some maybe a little under, some maybe a little over. Who's moving? Who's going for the 7.5% mortgage now? So there's been such a degree of stability in that area of the market. Has that surprised you?
Well, it's all about modeling prepayment risk, right? So it's about interpreting what homeowners are going to do, how they're going to respond, when they're going to prepay. And it's very rational for homeowners to prepay when interest rates go down, but when they go higher, people don't want to move. And that's created more of a wealth gap in property prices because it's so expensive to buy a home now. If you're not already in real estate, what is a regular person going to do? So I think that's also another problem, going back to the Fed using their balance sheet more. A third of their balance sheet is mortgages. They can help normalize things because markets are distorted in fixed income. The yield curve is more inverted now than it was in the late 80s. You think you buy a 1-month T-bill and get paid 5.25%, or you could lend the U.S. Treasury money for 10 years and get 1% lower. Like, that doesn't make a ton of sense, right? Like, normally you take more risk, you get higher reward. In this case, you take more risk with duration, you actually get less return. So the markets are definitely screaming that the rates markets, the bond markets, with this inverted yield curve, that a recession is coming.